Hi everyone, in this video we're going to be taking a look at the chapter 4 exercises, and in looking at those we're going to be analyzing merchandising, inventory type transactions, etc. And so without further ado, let's get started. Alright, to begin, I'm going to let you all work on the first section. I think that's just information that you can pull out of your notes or the book, etc. And as always, just there's drop downs, selections, same type of deal. Excuse me, down here as well. So I will leave that for you all. But let's jump over to tab number 2. So in tab 2, we've got a number of different transactions to record here. So on January 1st, we purchased 100 units at $2 each from Supplier Co. Certain terms. So the first thing we want to do is pick our accounts. And when we're talking about purchases and inventory, merchandise inventory is going to be our debit for an increase to our asset. And on this one, it shows terms, all that stuff. Whenever we do these merchandising transactions, it's always with an accounts payable, essentially, as the credit there. So we got to do a little math here, nothing crazy, but we bought 100 units at $2 per unit, leaves us with $200. Okay, then we return 10 units to supplier company and received a credit memo. So we're essentially just going to do, like a reversal. I'm going to make sure we pick the right account. Merchandise inventory goes down, accounts payable goes down, and we're doing 10 units at $2 a piece. So that's $20. Okay. Now we're going to issue a check. So what we need to look at when we're issuing checks or receiving payment in these transactions for merchandise inventory type transactions, we have to look back and see what are the terms and understand whether or not a discount has been realized. And so we can look back here on January 1st and see that the terms were 2% discount within 10 days of payment. And we are making the payment, looks like, on the 8th. So within that 10-day period, which would be the 11th, essentially. So since we paid before January 11th, we get a discount. So the first thing I like to do is to start with payables. It's going to be a reduction in, not a debit or a credit. That's an increase to payables. So let's go up here and put the right account in. So our payables are going to go down, and they're going to go down by the full amount that we owe, regardless of the discount. So start there, and you can see that we started with 200 of payables, and we reduced that by 20 because we returned certain amounts. So that gets us to $180. And then we're issuing our check, etc. So we're going to have a cash payment. And this is where we need to we could figure it out here, or we could figure it out here, our discount, essentially. So we are within the discount period, like I said. So we get a 2% discount on the amount we're paying. So we can go up to our total of $180 for the payables. And if we want to calculate the amount that we actually owe, it's the 98% because we're taking a 2% discount. So the discount will be 2%, and the actual payment will be 98%, not 100% essentially. And the journal entry to record the discount then is going to be the difference between the two as a credit. Oh, why did that not work? Or in other words, to say we're paying this much, accounts payable goes down by that full amount, and there's 2%. That's funny, that didn't work, because if it's this minus that, interesting. Maybe it's a decimal place kind of thing, but that's the same number basically as doing 2% there. So sometimes you have to play around with it a little bit to make sure you're getting the right number. But there, like I showed there, there's different ways to arrive at the difference in the number there. And this is 2% of the total amount that we owed was being reduced for a discount, and then the cash is the residual portion that's actually paid. Okay, now let's look at a purchase. Another purchase transaction. Sorry. similar type thing. So we've got merchandise inventory going up. We've got payables going up also. This one is 70 units times 250 each. Increase in asset and liability. Then we return 5 units. So again, we're just going to basically reverse our original entry for a portion of it because we're returning some of the inventory. So this is going to be 5 times 2.5. And then we're going to make the payment. So again, let's look back here. And we had 15 days to make the payment to receive a discount. But we paid on the 30th, and this was on the 14th. So that's 16 days. And we're not going to get the discount at that point. And so we're just going to make a payment here. It's interesting that there's 3 spots because we really, one thing to note, there's no X's down here. So that's kind of a clue, I guess, into the fact that we're just going to be making a normal payment with no discount, essentially. So we've got cash and we've got accounts payable. And the only thing we really need to look at is to make sure that when we're calculating the amount of accounts payable that we actually owe in the payment, we need to back out the portion that was for the return. Okay, so we had this extra spot as just a kind of a little tricky thing to make sure you know what you're doing, I guess. Okay, let's go on to tab number 4. So here in this tab, we're going to record sales journal, related kind of sales type journal entries. The format we're going to be using in this section is with the debit credit kind of thing. In the other videos, I like to sometimes break them apart into 2 separate entries, but either way works. And so to get points here, we have to follow this style. So we'll do that. And as you can kind of tell from, that gives you an example of what a lot of these entries are going to look like. We've got the accounts receivable portion, and then we've got the cost of goods sold, find the right entry there, and the reduction in inventory. Okay, and this one tells us we sold 160 units for $4 each, so the sales piece is $4. And then the cost of goods sold piece is 160 times $2. And there's certain terms, etc., that we'll consider later. Okay, and then the customer returns some of the units here, and we're going to issue back a credit memo. So one thing to remember is we don't reduce sales directly. We use a contra revenue account. We don't reduce sales revenue directly. So instead we do sales returns and allowances. So that's the one little change. So that is different from just, if that wasn't the case, we could just absolutely use the reversal of these types of entries with the amount, for the number of units. But we use a separate account for the sales returns. And what that does is it allows us to analyze the sales returns and allowances by themselves so we can see the full amount that reduces sales, so we can kind of analyze that distinctly from just grouping it all within a reduction back to sales directly. Hope that makes sense. So what are they returning? 10, and it was $4 each. The sales returns part. Accounts receivable is going to reduce because they're not going to pay us for something that they returned. And then for the inventory piece, we can just basically do an exact reversal of what we did above. And in this instance, this tells us it was 10 units times $2 per unit for the cost piece. And that is the total entry there. Okay, and then we got a payment. So we definitely got some cash. That's one thing to note. Some accounts receivable is going to go down, and then we are going to potentially be issuing a discount in this instance if they paid within the time frame. So the purchase happened on the 6th. They had 10 days. If they paid within 10 days, they get a 1% discount. They paid within 4 days because it's on the 10th is when we received the cash. So it is within the discount period. So we need to offer, we're going to receive less cash than we would otherwise if we didn't have the discount. So the first thing I like to do on these types of discount problems is just get rid of the full amount of AR, right? And this does account for the fact that some of that AR was reduced because we had a return. And then So this is the full balance of AR that's outstanding and owed, but the cash that we're going to receive is less than the AR by 1% because they got the discount, basically, right? And then we can take 0.01 to be that. This is the 1% of 600, basically. And we're going to record this debit contra revenue, we'll say, as a sales discount. So again, you could imagine that we could be debiting sales directly to reduce sales to reflect discounts and returns and allowances. But again, we use a contra revenue account so that these discounts and sales returns and allowances are in their own separate accounts, and we can analyze those distinct balances to understand what percentage of returns and allowances we have as a percentage of sales, so on and so forth. So we separate all that out just for analysis purposes, basically. Okay, so now we sold some more merchandise here. So let's do our similar transaction, kind of familiar journal entries. And in this instance, we sold 60 units to client company for $5 a piece. Cost of goods sold was $250 per unit. We had 60 units, so that's good. And then they returned 4 units, so we can kind of just follow what we were seeing above. It's very similar here. Sales returns and allowances, and then a reversal basically of everything else. Oop, it's not the reversal. Let's see. What do we want to do? Merchandise inventory coming back. And then cost of goods sold going down. Okay, so in this instance, it was 4 units times 2. Oh, sorry, 4 units times $5 for the sales piece, the revenue piece, and then the cost of the inventory to us was 4 times 2.5. Okay. And then we're going to receive our payment, and let's look back to see if they have, if it's within the discount period. 2% if we paid within 10 days. This is, let's see, the 12th. Yeah, so it's after the 10 days. That would be May 22nd, but it's beyond that. And so no discount. We're just going to get cash and accounts receivable. And then just remember, we take our full amount of accounts receivable minus our returns to give us what is the full amount, the outstanding balance basically at the time of payment. Okay, let's jump on to tab number 5. And now I think we're going to kind of combine the sales and the purchases side essentially. So, or purchases and then sales, I should say. Okay, so we purchased 800 units, yada, yada, yada. So now we can go into inventory. We're going to do accounts payable again. Our 800 units times 10 cents, so $80 total. Great. Okay, now we're going to be over here recording our typical sales entry. And so remember, we've got cost of goods sold. And this is 640 units times $1 each. Okay, that's easy math. And then we've got 640 units, so times 10 cents each. So you can kind of tie those together till you see how it was 10 cents here. So maybe we're selling the things that we bought above, so you can kind of see how those sort of connect there. And then the client paid us, client co, so they paid us 14 days later. So that's not within the 10-day discount period. So no discount was used here. So we're just receiving the full $640 noted above, and that is done with that one. And then we're making the payment, and we're paying on the 25th, which is way late, 23 days after, right, we purchased, and this was only 10 days to get the discount. So we didn't get our discount either when we're buying the stuff. So that was just $80, or we can link it from above. That's that transaction. Okay, now we purchased 184 units for 30 cents each. So same, a lot of this in this chapter, you see a lot of these same types of transactions. So hopefully a good chance to get good at the accounting here. Okay, then we return 24 units. So again, with our returns, we're just doing just basically like a reversal here. We got rid of our inventory and our accounts payable goes down, but now we just have 24 units times 0.3 instead of the 184 we originally bought in total. Okay, and then we sold 160 units for 70 cents each. So let's get back and do our familiar sales entries. $160 times 0.7 for the sales part, and then the cost was 29 cents each, so times 0.29. Good. Okay. Then we paid the vendor company. So let's take a look and see if we got the discount here. This is purchased on October 26th. And we're making the payment on the 29th, so 3 days later. We had 5 days, and if we do it within 5 days, we get a 3% discount. So it is, the 29th is within 5 days of the 26th. So that means that we are going to get a discount on this transaction. And let's see here. So the first thing again to do that I like to do is just to fully clear out the payable or receivable. In this instance, we're talking about making a payment to a vendor, so that's a payable. And let's go back up. Originally, we owed $55.20, but we returned some of the units, so that's the $7.20. So $48 is our outstanding amount of AP that we're going to clear out. And then we're going to take the discount of 3%. So we're going to multiply this total amount paid by 0.97 to get the amount that we still owe. And then we're going to reduce our inventory by the other piece, which is the 0.03 or 3%, because we're paying less for the inventory. Therefore, the cost of the inventory on our balance sheet should be less than the full amount because of that discount. Okay, and now Buyer Co. returned 20 units to us, and we issued a credit memo. So where was Buyer Co.? Oh, that's this one right here on the 28th. So again, remember we have the sales returns and allowances account, contra revenue, but then we can basically just reverse everything else. So accounts receivable goes down, merchandise inventory goes up as we're getting the inventory back, and then cost of goods sold goes down because it is no longer sold, basically. And they returned 20 units, so the sales piece was 0.7 each, so $14, and then the cost was 29 cents each. That's just from the explanation here, times the 20 units. And then we received a payment from Buyer Co. And we can see that this happened. Let's see, Buyer Co. is the 28th, so it's 3 days after they made the purchase, they're making the payment, and we offer a 2% discount. So 10 days they made it within 3, so they do get the discount. So again, first thing to do, reduce our receivable 100%. So the original receivable was $112. Then they returned $14. Oh, that was weird. It shot me up on the screen there. So our remaining receivable after the return was $98. And now, or let's do the discount first this time. So let's do sales discounts. And the sales discount is going to be 2%. So times that by 0.02. And then the cash that we actually end up receiving then is the difference. Let's see if it works. Yeah. So the difference between the two, the remaining cash. And another way you could have done that was just to take this times 0.98 or just the total minus the discount. That's both to get the same answer essentially. All right. So that's a combination of the purchases and sales. And then we can go through some of these other transactions, some of these other problems. I'm going to leave this for you all again to be able to go through your notes and your book, etc. Practice that yourself instead of just copying what I'm doing there necessarily, and give you a little bit of just, it's just the multiple choice type stuff. Okay. Now, though, let's prepare a multi-tax income statement and assume a tax rate of 20%. All right. So what we want to do is we want to start with sales. That's the top part of our income statement here. And then this, like I was talking about previously, we're going to have sales discounts and the returns and allowances as contra revenue. So our sales is 500 just from above. Our sales discounts is 10. Our sales returns, and I wonder, I guess you could do it either way. So we'll just do negatives here because that is how it shows up in some of the other materials. Sales returns and allowances of $20. Then we get net sales. So this is the amount. I guess I gotta pick it out here. Sorry. Oh, did that work? Maybe that worked, but anyway. It's interesting. I thought you always had to pick the drop down, but maybe you can just type it in. So the net sales then becomes our gross sales minus our discounts and minus our returns. Again, we do that. We have these broken out separately so that we can analyze them individually. And then that will bring us to the spot where we're going to calculate gross profit here. And the difference between net sales and gross profit is the cost of goods sold. So our cost of goods sold is 160, and then net sales minus the cost of goods sold brings us to $310. All right, operating expenses here. These are some of the normal cost of doing business. Looks like we've got depreciation expense. We've got rent expense. Remember that interest expense will go down below in this section here. Let's see what else we have. Wage expense is a cost of normal operations. So depreciation expense 60, rent expense 140, and wage expense 80. So we'll add all three of those. And then we're going to get operating income at this point. And that's going to be our gross profit minus our total operating expenses. So 30. And then we're going to want to go through and list out other gains and losses and revenues and expenses, etc. So let's see what we got. We got gain on sale of equipment. We've got loss in the sale of machinery. So all these things are things that are not directly related to our core business operations necessarily, is kind of what we're saying here. We've got interest revenue and interest expense. And let's see, what else could we maybe have in here? Maybe have one more thing. Gain on sale, loss on sale. Oh, maybe rent revenue. Yeah, rent revenue. It looks like that could be kind of a ancillary, just something that we earn money on in the business. Like when I was working for the bank, we had an office location that we ended up subletting out. So we rented it. We had another tenant move in. was paying us certain amounts, and that income was not related to the core operations of the bank. So while it was still income and revenue, but it was not, it would be more included in this section down here. So gain on sale of equipment, loss on machinery, interest. Oh, what did I do there? Loss on. Oh, we have to do negatives. Good call. When the numbers are all within one similar column, like kind of we had up here, that's where you would down in this section, having the positives is okay because they're all expenses. So it's not like you have to differentiate between positives and negatives. But on this section, because you have positives and negatives all within one area of the financials, then you do have to put the negatives in there. Oh, no, that's not right. Interest revenue is 20. Interest expense is negative 30. Again, we'll put the negatives. Rent revenue is 60. And then we can just auto sum all those. Okay, so we have total other non-operating income. That's going to be a positive. And then let's go into the bottom section here with pre-tax net income. It's the last piece we have to look at is taxes. And that's going to be our operating income plus our other non-operating income. And now we've got income tax expense. And we're just got this real basic pre-tax net income times 0.2 or 20%. But we want that to be a negative there as well. Again, it's within the same column of all that stuff, of positives and negatives. So we wanted to have the specific sign. And now at the very, very bottom, as we come to the end, we take our pre-tax net income minus our tax expense, gives us $64 here in this version. With my numbers, yours will be a little different, obviously, as you've seen throughout. But that is all the proper categories, etc., that you'll need to input. So, all right, let's move on to the next. All right, on to number 9. So I'm going to leave this one for you all again. This is just an exercise in going through understanding the normal balance. Remember, the normal balance is what side of the left or right on a T account, etc., or in ledger, whatnot, is the increase. So we have to just look and see, buildings or assets. That's going to be a debit normal balance. Assets go on the balance sheet, and those are going to be in non-current assets, so a plant asset, plant, property, and equipment. You'll see often PP&E, building equipment, all that kind of stuff falls in that category. So I'll let you all use your reference tools, books, text, notes, etc., to solve those problems there. Pretty straightforward. Okay, let's take a look here at our next problem. And in this problem, we're going to be looking at the quick ratio, essentially. And the quick ratio is similar to the current ratio, but whereas the current ratio takes into current assets and current liabilities, here we're going to be taking just the most current assets, the quick assets, if you will, which is going to be things like cash equivalents, accounts receivable, and marketable securities. So let's take a look at that first. So what kind of quick assets do we have? We have AR and we have cash, and do we have anything else that would fall? Short-term investments. I think yeah. Since we're saying they're short-term, that's gonna be part of our quick assets here. Or let's see if I'm sorry. Yeah, I'm sorry. That's just our quick assets. We're doing the ratio here, not just the termination of quick assets. So that's great. And then what's our quick assets divided by our current liabilities? So our current liabilities are going to be things like accounts payable plus, what else do we have? not notes payable due in 5 years, right? That would be a long-term, non-current liability. But wages payable would fall in that category. So 50% basically. Is its quick ratio good? I would say, yeah. The answer is no. I think what we're saying is if we just have enough to pay off our current liabilities, and so that's a bit thin in terms of having enough assets to manage the liabilities that we have coming soon. So our liquidity, we might run into some liquidity issues and us not having enough cash to pay our upcoming bills, essentially. It's not terrible. It could be worse, but we could have more liabilities than assets, but still not great. Okay, what is Crazy Co's gross margin ratio? So here we've got net sales. Remember, that's sales, gross sales minus returns and discounts. And that equals 500. Oh, I guess we just have to. I just put this in. It's funny. Let's do the formula and see if that works just to come out to a percent. So net sales divided. Let's see. Do we have? Does it just tell us? All right. We need gross profit first of all. So we need. Gross profit is going to be net sales minus our cost of goods sold, and then divided by our divided by our net sales. So again, net sales here minus cost of goods sold, and then so basically, in other words, like what was our gross profit? How much money did we actually earn from selling something after accounting for the cost of the cost of buying it ourselves before we sold it? And then saying, okay, we had $200 from that. That means that we were keeping 40% of the total sales that we earn. You can sell something for $1 million, but if it costs you $2 million to buy, you're not making money, right? So that's the whole thing that we're thinking about, is how much of our profit on selling something, or not profit, but how much of our gross revenue from selling a product is eaten up by the cost that we had to pay to get that product in the first place. And the higher that is, the better off, the more profit we're making. Okay, if the industry average is 30%, is our gross margin good? Then we would say yes, because we're keeping more of our gross sales dollars after factoring in the cost of goods sold. Okay, so let's jump back into our journal entries. We've got journal entries using the perpetual method, and then just a few other adjustments here, in journal entries, etc. So here's a purchase of inventory problem. So let's get back into our merchandise inventory and our accounts payable. Asset going up, liability going up. We've got 100 units. We're paying $2 a piece for those units. Now we're going to return 12 units, and we're going to basically reverse that original entry. And then we're going to pay this bill here, and we are paying 5 days later. We had 10 days to get a 2% discount, so we're going to get a discount. So our AP, again, I like to start with the payables going to 0. So our net payable that we owe at this point after factoring the returns is $176. And then we're going to pay cash. So let's go down to cash, and we're going to be paying 98% of the bill because we're taking the discount. And then we need something to balance this debits and credits, and that something is a reduction in the inventory value. It doesn't like it when you do that because we're paying we're taking the discount and paying less. So the merchandise inventory that we keep on the books is only the amount of cash that we paid for it. Okay, which is $172.48, right? Okay, so now we've sold a bunch of units, so we're going to again do that similar type of entry here. So our cost of goods sold, our inventory goes down. Oh, we sold 80 units at $3 each, and then each unit costs $2. Okay, that's good. And then we received the payment 2 days later, and they had 5 days to pay us to get a discount. So they are getting a discount. So again, let's reduce our payable 100% to start. And again, reduce our receivable, which was just $240. There's no returns, between the sale and the time of collecting payment. We received some cash, but the cash is going to be 97% because it's a 3% discount of the total. And then remember the account sales discounts, and that is going to be the 3% there to total it out, debits and credits. All right, purchaser returned 10 units, and we issued a refund check of $96. So at this point now, we've got to kind of factor in the account for the fact then that we already received the payment. So now we're actually sending cash back out, right? So this is a little tricky. So let's just think about this here. So we have sales returns and allowances, we want to same type of process. Then we've got not accounts receivable being a credit, but rather cash. A lot of times what we've seen so far is if they're returning before they paid, we would reduce the receivable, but they already paid. So then we're gonna record a return of inventory to our balance sheet, and we're gonna reduce our cost of goods sold. Okay, so let's see, what was the amount that they returned? So 10 units, and we want to figure out, let's see, how much was the sales return, and we need to factor in the discount that they paid as well. So they only paid us $232.80 for the total for these for the goods. So the effective actual sales revenue basically related to this was $232. Let's do a formula. $232.80, and that was for 80 units, and we're going to multiply that by 10 to get $29.10. So that's a little tricky. We have to just think about if they hadn't taken the discount, then we would just take 240 divided by 80, because what we want is a per unit cost. So if they hadn't taken the discount, it would be the total original sale divided by 80 units, or $3 each. So maybe that's another way to look at it, is it's $3 each, and if they hadn't taken a discount, then it would be 3 times 30 coming back, or as a refund back to them. But they took a discount, so another way to say the same thing we just looked at was 10 units returned times $3 per unit times 0.97. And then, is that everything? I think that's everything. Yeah. So it's not $3 anymore that we originally sold for $3, but because they paid quickly, it really becomes not $3 per unit here. But $2.91 per unit after factoring in the discount that they took. Okay. So we're going to issue back the $29.10. And then regardless of the discount, etc., the cost doesn't change, so that just comes back to us at full balance there. A little tricky, so hopefully that's helpful watching me work through that. Okay, now we purchased some inventory. So we've done this quite a few times. We've got accounts payable and merchandise inventory, 100 units times 5 for easy math. And then we sold 90 units. So let's do our typical sales entries here. In our COGS, 90 units for a price of 7 per unit, and the cost of those 90 units was 4.95, not 65. Okay. And then let's see, what are we doing? We paid vendor company. Maybe we have to look back here and see what was vendor company. Oh, that was just that purchase right there. So we bought it on the 22nd. We're paying on the 29th, so 7 days later. We had 10 days to get 1% discount, so we're within time. So we're going to get our discount. Again, step 1, reduce your payables 100%. There's no returns, so we just do that. And then I like to kind of go to cash right away, and then how much of cash we actually going to pay, not 100% because we're getting the discount. So we're going to instead pay 99%. And then because we're paying less, our inventory is going to be, worth less in essence. It's going to be on our balance sheet at less because it's only worth what we pay for it, actually pay for it. So that's our credit there. Merchandise inventory. Okay, on December 30th, client code returned 4 units to us, and we issued a credit memo. So that's related to this one. And let's go to our returns and allowances. AR is going to go down. Inventory is going to go up. And COGS is going to go down. And that was for 4 units. And we sold them at $7 a piece, so $28. And then 4 units times 4.95 gets us there. And finally, we received payment. So what I like to start with, and again, is, okay, let's take a look first because I think this doesn't have any X's here. So right off the bat, you can tell there's not going to be a discount, it looks like, because it's not within the time period. This is what I can kind of gather there real quick. We said sold 90 units to client company, so they would have got 2% discount in 10 days. But this is well beyond 10 days because we're in the next month on the 15th, January 15th, sold on December 27th. So no discount. We're just getting cash and reducing the receivable. And the total was $630. Oh, wait, is that right? Oh, sorry, there was a return. Again, don't forget to net out your returns. So the ending amount of receivable that we had was 602, which originally 630, but then they returned 4 units, reducing receivables by $28 to bring it to $602 total. Okay, so I'm going to leave this to all of you all to complete through. This is very similar to the problem that we had. I think it was number 8. So I'm not going to go in detail on that again. I'm going to leave it for you. It's mostly just a matter of going through and picking the right accounts and following the same methodology that we did previously. So let me know if you have any questions on that as we go through, though. All right, on to number 13 here. So in these 2 entries, we're going to do an adjusting entry and an allowance entry to account for the fact that we have, some estimations of returns and sales discounts that are still out there. These aren't returns and allowances that have actually happened, but based on these revenue recognition standards that have come out relatively recently, we have to do some journal entries to adjust our ending sales and all that, and our discounts, etc., adjust our net sales overall to account for the fact that it is possible and likely, I guess I wouldn't say possible, it's likely that there will be some returns, and there will be some discounts taken still on the amounts that are eligible for those things. So the first thing we want to record is an increase to our sales returns and allowances. So that again is our contra revenue account. And the credit related to that is going to be an increase in our sales refunds payable account. And then our other, so let's do the calculations on this piece first. So it tells us that we have $350,000 of sales still eligible for returns, and there's a 5% estimate. We estimate that 5% of that will be returned. So we're reducing we're increasing our contra revenue sales returns and allowances account, which in turn reduces our net sales overall for the estimate, because we need to estimate what's still going to be returned. And then to go along with that estimated return, then we're going to want to record an asset to kind of go along with this return, an estimated asset. And we're estimating that the merchandise is typically 60% of sales. So if we're returning this much in sales, then 60% of that would be $10,500. And we're going to reduce our cost of goods sold accordingly, similar to just a normal refund. Not refund, a normal return. And so all we're doing here is very similar. We don't have real inventory coming back. We want to keep this in its own account, its own estimated inventory return count. And we're not actually, at this time, issuing the actual dollars back like you would with a real return. So we're recording these two kind of special accounts for the revenue recognition policy adjustment. But in all other respects, these two accounts, the sales returns and allowances and cost of goods sold reduction, are both the same as for a standard inventory return. Okay, now so that was one piece, and then we've also got to estimate our discounts. And so there's some information above it tells us, and what we want to do is to increase our discounts kind of as per usual. And then our credit for that, our liability, is going to be allowance for sales discounts. So we're not specifically actually reducing, any asset necessarily or receivable or anything. In this instance, it's an estimate, but we are going to put in this credit to account for the fact that we're going to estimate a portion. It's likely that we will not receive a portion of this amount outstanding. And so we have $70,000 outstanding that falls within the discount period still. And we think, based on historical trends, etc., 90% are going to pay within that discount period. So if we have $70,000 outstanding and 90% of that is going to pay, is going to pay within the discount period, then we're estimating that 90% of 70,000 is going to get a discount, and that discount will be 3%. And so taking all that together and doing the calculations gets us to $1,890. So total eligible, 90% we expect to pay within the time frame, and of those 90% are going to receive a 3% discount on that $70,000 basically. Okay. And that's the two adjustments that we need to account for: the estimated returns and sales discounts due to new revenue recognition standards. So thanks, everyone. Appreciate you following along with me in this video, and I will see you in the next one.